Yeah, I don't think it's unexpected. I think the really serious issue would be whether it spreads to Europe. So at the moment, I expect it stays just in the US as a ban in the US. Obviously, the timing is telling you a lot. I mean, a week ago we were expecting some sort of trade deal to be done. I think the market's expecting that, and at the moment that's looking less likely. We're still hoping it's a bargaining chip. We're hoping by the 1st of June there could have been more hope that a deal was done. I think that now has to be looked to the end of June with the G20 conference in Japan. So, how are we playing that? Markets went up quite a long way. We took a little bit of profit. We still think that emerging markets in Asia are a good story for the next year. But the next 2 months is going to be quite whipsawy and volatile, driven by the trade news.
Okay, well, tell us why they remain attractive, because you are overweight China. Fresh data out just overnight from the IIF, though, showing that capital outflows out of China are at fairly significant levels, about 4 billion when it comes to Chinese equities just in the last week and a half or so. Why do you remain positive then on China? Because the data points have been weakening as well.
I think, the rationale, I think, why markets have gone up this year was not to do with the main reason that we like emerging markets and China for the next year. And that reason is that we would expect to see a stabilisation in GDP growth, not until the second half of the year, and we are beginning to see earnings revisions being downgraded less, and we'd expect over the next 6 months to see earnings to be flat or potentially being upgraded. And that's why we think that we should be overweight emerging markets, and within that, China. Markets went up this year because of rate expectations changing, because of the hope of China trade, and because the hope, I think quite falsely, that China economy would recover very, very quickly through stimulus. Now, we think that recovery is going to be slower, but will come through in the second half of the year. So, yeah, profit taking will happen now. As I said, actually, if you look at the news headlines, it's amazing how resilient the markets are, how well they've done year to date. So I think a lot of the move, what we're really trying to say in technical terms, has been just a change in a re-rating. It hasn't been driven by earnings. It's been re-rating from a huge de-rating last year. So yeah, the next couple of months could see definitely markets being much more shaky. If the trade issue doesn't happen, if there is no trade deal, then we still would have upside of markets, but we've got to then start looking at the earnings picture. So at the moment, it's really driven by earnings and we're from these valuation levels. If we could have another 5–6% fall in markets due to volatility over the next few months, but we would expect that would be a good opportunity to enter the market.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.